Okay. Meantime, we are expecting another 75 basis point interest rate hike from the Fed today. Join us right now to talk about how investors should try to position their portfolios ahead of the big decision. Sarah Malik is here, Chief Investment Officer at Nuveen. You saw how we set up the segment. I'll just ask you the question. How would you set yourself up?
Well, we expect two things today, and that is that 75 basis point rate hike and peak Fed hawkishness. But any rally on that should be short-lived, and that's because components of inflation remain sticky, particularly rents and wages. And that leads us to our key risk for 2023, which is earnings growth estimates, which are unrealistic. They're running over 5% right now growth. We don't think that that's attainable next year. So given that, you need to position your portfolio in equities in companies that are resilient to earnings and have pricing power. So for example, companies in technology like software area, and also defensive companies within the materials and industrial space. Those are areas that we think can have pricing power, pass through contracts, and also resiliency to earnings.
And what's your gamble in terms of what we hear today? Not just the 75 basis points, which I think is already baked into the cake, and it would be a surprise, obviously, if it was more or less than that. But what Jay Powell ultimately says about what he's going to do next.
I think it's going to be a balance, because if they're too dovish, that leads to a market rally in itself that can be inflationary. So I think they're going to be balanced in terms of, yes, this could be the peak in terms of hawkish rate hikes and 75 basis points. But going forward, I don't think they're going to guarantee any kind of pivot going into 2023 or in 2023. It depends on the data, and the path from inflation to 8% to 4 or 5% may be easy, but getting their target rate is going to be challenging. And that's why we think there could be upside to the terminal rate when it comes to the Fed funds rate. And also we could get this longer tail of moderate but lower rate hikes. And that impact on the markets likely leads to lower earnings growth, manufacturing data that continues to slide into recessionary territory, and finally employment cracking. So
just so I don't misunderstand you, it sounds like you're saying the market is too high right now.
Yeah, I think that's because of earnings that are too high going into 2023, and that leads to valuations being too high. So what we just witnessed is likely a bear market rally, any rally going forward because of Fed commentary.
Okay, so
another bear market rally.
What's your downside expectation, let's say, over the next 12 months? And to the extent you have any upside expectation, which sounds like you don't, but if you were to, and what percentage you sort of put on something good happening?
Well, we could see the S&P going down to the low 3,000s based on earnings finally cracking and manufacturing and employment data. On the upside, it really depends on inflation. If we can get that inflation number down to the Fed's target level, then the Fed pauses. If we hit a recession, the Fed even pivots in that case if inflation is low enough. Our risk, though, is that inflation hits more of a moderate level in the 4 to 5% range. That doesn't give the Fed the ability to pivot. And we do hit a recession, as we're seeing already manufacturing data move to contractionary territory.
Right.
That's the challenge for the upside scenario for the markets.
When you think about being a long-term investor, what we're talking about is very sort of short-term. How do you position yourself right this moment? But if you were to position yourself 2 to 3 years out, there's some, people who would say, look, things are actually going to get, invariably things should get better, and you'd hope that they would. But then there's others that have a view that we will be living in some kind of version of stagflation for a very long time.
Well, even in that, there's still going to be companies that can outperform in those areas. And so we talked a bit about software and materials. So Linda, which is an industrial gas company, we saw them beat and raise last week. We think their guidance is conservative. They have pass-throughs for inflation in their contracts. So they have pricing power, margin resilience. They have a clean energy growth story, and they pay a nice dividend yield of about 1.5%. ServiceNow, another company, beat and raised last week, 98+% renewal rates. Low M&A risk going forward. Also, as vendors consolidate in a potential recession, they're going to move towards companies like ServiceNow. So you can still find your companies that will continue to do well in this environment, but you need to be more selective.
Shepard Smith here. Thanks for watching CNBC on YouTube.